What's good, YouTube? It's your boy Charles Enoch. Y'all already know we back with another Invest in Myself episode. So let's run the intro. So for today's episode, I want to go over strategies for mortgage forbearance and mortgage deferment and incorporate velocity banking into it. But before I get into it, you already know your boy has to do the YouTube thing. So I'm a couple 100 hours from being monetized. So I'm gonna ask you guys, help a brother out. So go ahead, smash the like button, make that thing turn blue. And if you're new to the channel or you just haven't done so yet, take a little time, hit that subscribe button for me. Also, don't forget to comment down below. Let me know if this video was helpful, things I can do better. It's very much appreciated. Also, don't forget to comment down below. Let me know if this video was helpful. I appreciate anybody that takes the time to do these things because it does help me reach a higher audience base. And don't forget to share the video. So I'm a little late in regards to doing a video like this because a lot of people have already taken forbearance and deferment, but a subscriber hit me up and they wanted me to tackle this issue. So about every homeowner knows when the pandemic began, mortgage companies were offering forbearance due to hardship and eventually offered deferment after that. So I want to first go over the difference between forbearance and deferment. So mortgage forbearance is just a temporary pause in your monthly mortgage payment. So whatever legislation was passed for federal home loans, I think you can take forbearance between up to 12 months to 18 months. But after forbearance, you have to pay those missed payments back in one lump sum. Now, deferment is an option for dealing with those back payments. And the option most lenders are doing is adding those forbearance payments that you didn't pay and putting it towards the back of your mortgage loan. And it's usually either in a lump sum payment after the 30-year mortgage, or they'll modify your mortgage where it's longer than 30 years. So quick note, just because you have forbearance doesn't mean that the bank is going to give you a deferment. You would definitely want to check with them. Now, there is a strategy for deferment that I'll outline because I've actually done it. So just like velocity banking, we're wanting to get capital from the bank, usually in regards to credit cards or lines of credit. We would then use that capital to make an investment, then pay the bank back. So with this particular scenario, the bank is allowing you, I'm going to say 12 months of no mortgage payment. So that's basically a loan and they're telling you to pay it back later on. Now I'm going to pretend that we're 10 years into a mortgage of a 30-year mortgage. So the bank is basically saying, hey, I'm going to give you this loan of 12 free mortgage payments and you're going to pay me back 20 years later. So what a lot of people have done, even including myself, have taken the forbearance and then getting the deferment so we can increase our cash flow by 12 months. We have either invested the extra cash flow offensively, meaning acquiring assets, or defensively, meaning paying down other debts, thus increasing the cash flow even more. Now, I personally chose a defensive method by getting the deferment for 6 months, and then those 6 months worth of free mortgage payments, I threw that on the HELOC to pay it off. Now, there is a downfall to this, and the reason why I only took deferment for 6 months instead of 12 months. Now, I can't say this is every lender, but the ones that I have called, they told me if I take forbearance, then I have to wait 6 months after the forbearance to apply for another line of credit or to refinance my HELOC. So I only took forbearance until the end of December last year, and I'm waiting 6 months. So in July, I will be getting a new set of HELOCs. I'll be refinancing my rental properties since the value of them have gone up. But enough about what I'm doing. You already know I have the whiteboard in the back, and we're going to go over a few scenarios of why deferment can be beneficial. And even for those that actually had to use the freed up cash flow from the mortgage to get back on their feet, and now they're seeing themselves in a more comfortable position. And they're thinking to themselves, How am I going to pay these extra payments that went to the back of my mortgage? All right, so let's get it. Let's go. All right, so we're at the whiteboard. You already know we get down to business here. So we're going to go over 3 different examples on what you can do with deferment and those extra mortgage payments that you have just been saving up. So we're just going to have an individual, we can have a couple, whatever. Their income is going to be $4,500. Their expenses are going to be $4,000. So they have a cash flow of $500. So they decided to take forbearance and they decided to get the deferment. So we're just going to use the averages of usually a mortgage payment in the US. I Googled it. They said it is about $1,200 for the average mortgage payment. So we're going to take that $1,200, we're going to times it by 12 for 12 months where we don't have to pay a mortgage payment, right? That's going to equal $14,400. So we pretty much got a loan of $14,400. Now we're going to learn what we should do with this money since we have deferment and it moved to the back of the loan. Again, we're going to say that we're 10 years into our mortgage. We still have 20 years left. So we have 20 years to invest this money and give it back to the bank. All right. So we're going to look at the first scenario. We're going to say this individual, they're going to invest their deferment money into stocks. So we're going to say the investment is $14,000, pretty much those 12 months worth of mortgage payments. Now, we're going to say that they're not even going to contribute anything monthly to the stocks. They're just putting $14,000 in the stocks. I'm not the stock expert, but let's say S&P 500. They just put that in there. The length of time they're going to put it in there is for 20 years because they still have 20 years on their mortgage, right? So they're going to start paying their mortgage payments, but this $14,000, they put it into the stocks there. And I Googled this here. It says the average interest rate is 10% every single year, modestly there. So we're just going to say a 10% growth every single year on average. In 20 years, this individual is going to have $94,185. And this is without them even touching it. They're not putting anything into it. In 20 years, they're going to get $94,185. So we can safely say that, hey, they're going to use some of that money and then they would just pay those back payments back within 20 years. So again, it's just like velocity banking. We got capital from the bank because they said, hey, you don't even have to pay your mortgage payment for 12 months and we'll just roll it in the back of your mortgage. So you have 20 years to pay us back. So we just use that money. We put it into stocks. We let it grow. We're going to say at a 10% rate, even if it was lower, we're still going to get a lot more than $14,400, right? So if this individual actually put $250 monthly, so pretty much half of their cash flow, we would see it be $206,010. So we can even see that even doubled from the $94,000. So again, a lot of people have done this. They have known the strategy of, hey, since it's COVID, legally, we don't even have to have any proof that we have a hardship. We can just kind of call them up and say we want forbearance and then get the deferment and then start paying afterwards. So we just basically got a free loan and now we're just using this money to invest to make more money, right? And then we'll pay them back 20 years down the line. I mean, that's nothing. As much as we made $206,000, I'll pay you $14,000, $15,000 back. That's nothing. All right, so now we're going to be on the next scenario here. So the next scenario is pay debt off quicker. So we're going to have an example. We're going to say this individual, they have $15,000 left on their car loan. So, and I just kind of use the averages on Google here. So the minimum payment for a car loan on average is $563. So what's going to happen is this individual, they're going to use their credit card to pay off the loan. Now you can do this by two ways. You can go through plastic, or you can do a balance transfer. So it doesn't have to be one credit card, it has to have $15,000 on it. You can do multiple credit cards, right? The thing is, we're going to be using our credit card or credit cards to be paying off the car loan in full. So for this example, we're going to use plastic. So plastic is going to charge a fee of 2.85%. And if you don't know how to use plastic, I do have a video, I'll put it down below in the links, on how to create a plastic account and start using that to be paying your car loans or your mortgages, etc. So after we use plastic and we calculate the fee on top of the $15,000, our balance is going to be $15,427.50. Now, what this does is it's going to increase our cash flow. So our cash flow, we have $1,200 from the mortgage, right? We don't have to pay a mortgage here. So our mortgage is $1,200. So that's freed up. We have our $500. So that's $1,700 plus the minimum payment for the car loan. Since it's paid in full, we don't have a $563 payment. So our cash flow now is $2,263 every single month, right? So the loan will be paid off in 7 months. So pretty much that $15,427.50 divided by the 2263. It's going to take about 7 months to get that all paid off with our new increased cash flow. Now, since it's only 7 months, we have 5 months where we're just stockpiling our cash flow. So with 5 months, no mortgage, so that's just the $1,200, we see that we're going to have $8,500 by the end of 12 months just by not paying our mortgage, plus the no car payment. So the $563 we see it's going to equal $2,815. So if we combine all that, and this $8,500, this is also including the cash flow of the $500. So it's the mortgage, the $1,200 plus the $500 cash flow we already have. So that's the $1,700 times 5. So I want to clarify that. But if we're adding both of those together, it's around $11,000 that we have saved up. Now, you have 20 years to invest this money to equal the $14,000 that you borrowed. Now, with the $11,000, I would probably just use the method of the stocks, put it in there for about 17 years, and you're going to get the $14,000 back to pay off. So this is another method that you can use, is pay off your debt to increase the cash flow, and then you have increased cash flow permanently, because the $1,200, we know that that's going to go away in 12 months, but the car is paid off and the car was $563. So now your cash flow on top of the $500 you have is $1,000. So that's going to do a lot of good stuff for you if you pretty much doubled your cash flow by first borrowing some money and then dumping it on a loan or something to pay that off to increase your cash flow. So that's another way of using that deferment to your advantage. All right, so we're going to be on the last scenario, and these are for individuals that, hey, I can't use this strategy in regards to stockpiling this money because I actually needed the money through the pandemic, to get back on my feet. Now I'm in a pretty good place where I'm making, majority of my income. I have a pretty decent cash flow, but how am I going to pay these back payments back? So what's going to happen is we're going to use house appreciation. So what's going to happen, I'm just going to break down some numbers and you can see how this is going to work. So again, I'm just using averages that I just kind of looked up on Google. So the average house price is around $287,000, just a little over. Now, the average appreciation rate for a home is 4%. And when we do that and we see the length of time, we have 20 years to pay the back payment back, right? We have 20 years to pay the deferment back. So if we're just looking at the average house price and the appreciation rate of 4%, and in 20 years, the final value of your house is going to be $629,000, right? That's the equity that you have in your house. So at some point in time, you're going to tap into the equity of your house. Pretty much you're going to get a HELOC. Now, it doesn't have to be year 20 when you have to pay the lump sum, but maybe year 18 or something like that. Maybe the value is 600,000. Either way, you're going to be able to get a HELOC out of it, right? And then you're going to use that HELOC to pay off your mortgage. And then you're going to use your HELOC as your bank account. So you're going to get your check and it's going to go into your checking account. You're going to put that into your HELOC. And when you need to pay expenses, you'll take money out of your HELOC and pay it that way. I'm assuming that you're going to have a pretty decent cash flow. We're going to say the $500 cash flow. You're going to be able to knock out that $14,000 of the lump sum. So you can basically bank on house appreciation. And then once it appreciates, you're just going to tap into the equity to get your home equity line of credit to pay off your mortgage. And then the home equity line of credit, you're going to use the velocity banking method. Now, if you don't know the velocity banking method, I have several videos outlining how to use your line of credit or home equity line of credit like a bank account by putting your money in to the line of credit and just taking it out when you have expenses. So this would be another way to pay back the deferment if they're putting it at the end of the loan. So I really hope this information was helpful. Again, I know I'm pretty late making the video, but there were a couple people that kind of wanted to know some strategies in regards to deferment. So here you go. And please remember, if you haven't done so yet, go ahead, smash the like button for me. If you're new to the channel, definitely hit that subscribe button. Or if you watched a couple of my videos and you just haven't done so yet, take that little bit of time, man. Hit the subscribe button for me. And don't forget to comment. Please put down a comment if this video was helpful, and remember to share with others. And like always, you guys have a good weekend. Peace out.